The market is close to an all-time high and the PE is also pretty high for the Nifty. Can I invest now or wait? This is the question on many people's mind, and let's discuss in this video what one should do. Hi, I'm Pattu from freefincal, and if this is the question on your mind, then I think you're asking the wrong question. And like I always say, if you ask the wrong question, you will never get the right answer. So let's look at the state of the market. So this is the Nifty 50 PE, and I have plotted the 10-year moving average. That's the central line here, and you can see that the 10-year average itself is tending up. It keeps going up. So you can't say the average of the Nifty is this much. It is not a particular value. It is a changing value. With every passing business day, the 10-year moving average changes. And so this is one standard deviation above, two standard deviations above, one standard deviation below, and two standard deviations below. And notice that the current Nifty 50 PE is well above 2 standard deviations. So people are now worried, will it come down? Because you notice that I think, I don't remember the dates, I think this was around early 2018, it went above 2 standard deviation and fell down, but it only fell down to 1 standard deviation and it bounced back. About a few months before that, it breached 2 standard deviation, it fell down, but it didn't even reach 1 standard deviation and moved out. So the point is, just because the Nifty PE is high, that is the price to earnings ratio is high, it does not mean the market is going to crash. It could come down. I don't know whether it's going to come down or not, but it could come down. But where will it stop? Nobody can say. It could just come down a little bit and then go back again, a little bit and go back again. You don't know. So you cannot, you can't say based on just this alone whether the market is going to fall, crash or something. The only thing is, you can have a system in place. You can have a tactical asset allocation system in place where you will, if the Nifty breaches the second standard deviation line, you will reduce equity allocation from, let us say, 60% to 20%, and then when it falls below the 2 standard deviation line, you will increase it up. But there's no indicator here, there's no reference line for you, because this is 2 standard deviation, this is 1 standard deviation, but notice that it does cross it. So suppose if you say, I'm going to have an algorithm where if the Nifty goes above 2 standard deviation, I will move most of it out of equity, and then I will wait until the Nifty breaches the 1 standard deviation. So if you sell here around this point, this is what around October 2017 or something, then you would have to wait until this time. So that's like almost like 8, 9, 10 months. You have to wait and then enter back into equity, and then you should have sold equity here and then wait. It will go up and then it will come down eventually at some point, then only you will buy. This is possible. You can do this. I have shown you using a backtest. You can see the link that this will work in reducing risk. Please recognize, tactical asset allocation is for reducing risk. It is not for enhancing return. Mutual funds do it. For example, Franklin Dynamic PE Fund does a very good job out of this. It uses a slightly different algorithm, but it gives you Nifty-like returns, but at 50% lower risk, which is fantastic. So it works. There's no problem there. But the point is that I am talking, please recognize this, I am talking about profit booking. I am talking about reducing your invested equity, shifting it to fixed income, that is safe instruments, then moving back to equity when you think that the PE signal is correct. That is tactical asset allocation. I'm not talking about when to invest the money that you have now, right? So you have been investing regularly so far. Most people who ask whether I should invest now, they are of two types. They have been investing regularly, suddenly they are worried about whether I should invest now, or they have just started investing and they are worried if I should continue investing. I think that's wrong. For both types of people, such a question is wrong. We can also look at the Nifty price and the double moving averages. Again, I have done the backtest for this. You can do the practical asset allocation with the double moving average as well. You can have a look at the video. I think I've also done the video. I don't remember, but I've written the post on it. So the red line is the 150-day moving average and the green line is the 365-day moving average. And you can look for crossovers. That is, when the 150-day average falls below the 365-day average, then you say that it's a bear market and you pull out of equity, and then you enter back inside when the 150 moving average moves past the 365-day average. But if you look at the current trend, if I zoom this area now, that's the current data. There's not much to say. You can see that the 150-day average is actually just moved past the 365-day average. So you can't say that it's going to fall down anytime soon based on this. The Nifty will tell you, the Nifty PE will tell you it's pretty high and it's heated up, but this will tell you it's not going to fall down anytime soon. So that's like, again, it's like blind people touching an elephant. Different technical indicators will give you different results. So you have to have a conviction and follow one of them. So the point I'm trying to make is that stop worrying about elections, stop worrying about events. Have a system, and no matter what, stick to the system by shifting from equity, shifting invested amount in equity to fixed income and vice versa, depending on the algorithm. You can look at any of my tactical asset allocation posts. All the posts are linked below. The archive is linked in the description box. Don't worry about investing, when to invest. Invest systematically, and if you are interested, asset allocate tactically, or you look at your goals and asset allocate based on your goals and do annual rebalancing. Don't worry about when to invest. That's a silly thing. You can invest systematically at all times, and you can either use an algorithm, either use double moving averages, use Bollinger Bands. I have a video on that. Use PE, whatever you want. Shift invested amount. Don't worry about tax. Don't worry about exit loads. And shift back and forth the invested amount between equity and fixed. If you don't want it, use goal-based investing. I have a video on that as well, how to reduce risk in the equity portfolio. Look at that. Don't worry about when to invest the next amount, the next installment, or the this month's salary and so on. That is silly. Okay? Keep investing systematically. So that's what you should do. If you have just started investing, you should continue investing, because the amount you will have in the market is pretty low. You don't have to worry about it, but you have to decide what you want to do, whether you want to do goal-based asset allocation and annual rebalancing and periodic reduction of equity, or do you want to have a more tactical approach using an algorithm based on the Nifty PE or the 200 DMA. If you have been investing for a while now and you are asking, I think this is stupid. I mean, you need to grow up, because if you've been investing for a while, and it just means that you still don't have a system in place. Come on, you have to have a plan. So whatever you do, decide. Don't look at events. Don't look at elections. Don't look at this and that as an event. Something happening, interest, RBI a meeting or whatever it is. They're all events. The market will react to events, but you look at technical indicators. Please recognize. Look at technical indicators only if you have the guts to reduce invested amount in equity and move it to fixed income and vice versa. If you don't have the guts and if you are worried, oh, there will be tax, there will be exit load, blah, blah, blah. If you are worried about all that, you are wasting your time. That is all that you are doing. You're just stressing yourself out. So have a plan. And yes, the market is at an all-time, it's close to an all-time high. So what? It doesn't matter. Unless you have a plan, it doesn't matter. Keep investing systematically, but take care of your asset allocation. Rebalance it either tactically or regularly once a year. So that's what I wanted to say. If you have any questions on this, please let me know. Thank you as always for watching. Take care. Bye bye.